Good evening, fellow investors. Assenderp here, and today I'm going to take you through a new series of mine called Understanding the Business. And in this case, I'm going to explain to you diversified gas and oil, otherwise known as DGOC. First of all, I would like to thank you all for the feedback I've gotten. I've gotten a few replies already that were very positive, and also some direct messages. It really motivates me to make new videos, so thank you. And I've also heard a few people commenting about my microphone. It was very soft, and I listened back to it and it sounded really soft, so hopefully that is fixed now. At least I looked into it and it should be fixed, so thank you for letting me know that. The goal of understanding the business. My goal with this series, basically, because it's going to be a 5-part series, is to make you understand the business that I have already suggested. So I'm going to walk you through some key points, and I want you to be able to know what you are investing in. I'm not going to make you the next operational manager or something like that, but if you remember everything that I'm going to tell you, if you're going to apply for a job in this industry that I'm making a video about, I'm pretty sure you can impress whoever is interviewing you. So the setup. I'm going to start off with a business model. Then I'm going to talk to you about the financial model. So how are they creating value? Then I'm going to walk through the statements. If the financial model is already clear, then the statements will be spent not a lot of time on. So keep that in mind. On the fourth part, we're going to look at management. So it's going to be a management analysis. So who the shareholders are, what are their experience, and so on. And the last part is going to be the outlook and the thesis that I'm having on it. So you can also expect the calculation in regards to the valuation in that topic. So today we're going to start off with the business model. And here you see the sheet from DGOC, and this is basically in one sheet and they explain what they're doing. So here you see what we do, the DGO business model. I have highlighted 4 parts here. The first one is target low cost, long life, low decline production. The second one is reduce unit operating costs, create efficiencies and improve margins. This will be covered in the business model. Then the last 2, the generate on equity and safeguard the balance sheet, those will be discussed in the financial model. So let's get started. Here you see how they have been creating value since they have been founded. So here you see in 2001 they founded Diversified Gas and Oil, and they acquired their first assets. This is basically the point where Rusty Hudson Jr. bought the wells from his father and started his own business. And you see steadily there hasn't been much growth, there hasn't been much development for like 9 years, and it basically didn't really do much until 2017. In 2017, they decided to go public to get extra money and to invest in certain assets. They created this business model, and this business model took off, and here you can see how much their production has been increasing. And here you see a CAGR since IPO of average about 200%. So this is the annual growth rate. Keep that in mind. This is just to show you how they have been growing. So to think about the wells in their business model, we have to understand what they are buying and when they are buying it. So here you see 2 lines, and they are explaining the kind of wells that they're buying, or the assets. You see the unconventional wells, which are as the green line. So they have an extremely high peak at the start. The production declines very quickly, and after like 5 years, they basically have the same decline as the conventional wells. So what DGO wants to do, DGOC, they want to buy it around the 60-month mark so that they have a low decline in production. And if you check here, it says 50 plus years remaining life. So it also has the long life. So that is how we know the first part of the two things that we're going to talk about. It was low cost, long life, and low decline. So here you can see the long life and the low decline part of the business model. Here they you can see the comparison between DGO and other Appalachian producers, so competitors. So the purple one is competitors and DGO is in the green. The green lines are the production, so you see that the production drops about 5-6% on average from the assets that they are using, while the cash increase is about, let's say, 3% per year. If you compare that to their competitors, you see a steep decline in production instantly, like 34%, then 13%, and then 7%. So this is basically the first 3 years in this case, or 4 years, that if you think back of the graphic we just saw, this is just a peak moment and then it goes down, and this is where DGO buys it, and then this is what happens following that moment. And if you look at the cash costs, they are looking for low cost. So here you saw the 2-3% increase in costs, and if you compare that to here, this is about 20% increase, and then about 15 or 14, and then it goes to 12. So you see in the start it has like a very increasing cost, and they are avoiding that by buying these low cost, long life, and low decline production. The second part that I highlighted was reduce unit operation costs, create efficiencies, and improve margins. The unit operating costs, we basically just saw how they're doing that, but in the financial model, we're also gonna come back to that and show you in numbers how they are reducing that. But I would like to highlight this sheet in particular, because here you see that they have both upstream assets and midstream assets. Upstream assets are basically the production assets. So you can think like the producing of gas, oil, liquid natural gas, and so on. And the midstream assets is kind of like the logistics. So how do you get whatever you produced from point A to point B, and in this case, the consumer. So they are buying both upstream assets and midstream assets. What I would like to talk about here is the midstream assets, because I haven't mentioned that before, but it is actually quite interesting. They are acquiring midstream assets because how it works in that area and in general with gas producers and midstream companies. If somebody wants to use those midstream assets, they are going to have to pay a fee. And by obtaining these assets, you no longer have to pay a fee. The only thing that you have to pay for is the maintenance. And by buying both upstream and midstream, you are creating a synergy, and that will reduce the lower unit operating costs. In the financial model, we are gonna focus on this part as well, because from 2018 and 2019, there has been an insane increase in the fee that they have to pay for the midstream assets that they're using from third parties. So that will make it clear why they are buying these assets. And just look at the bottom of the sheet, you see that they have increased the production by 107%, which is a very nice increase. And here you see that they have decreased the cash cost per barrel of oil equivalent. We will come back to this in the financial sheet as well, the financial model, sorry. And here you see how much they have expanded their midstream assets. So they have basically obtained 1,500 extra miles. So nothing to complain about, a plus 14% increase. Their business model is very different from other gas and oil companies. Here you basically see a summary of that. So in the red you see the perception. So if anybody who has experience in the oil and gas industry is looking at their financials or their statements or whatever they're saying or expressing, they will assume this. But if you look in reality, what they're doing, if you go in depth into the company and not per se the industry, you will realize that there's actually an important difference. So let's take a few out of here. Cash deficient. So if you look at the balance sheet, as I mentioned in the previous video, you will see that they have no cash. So any other investor would think, okay, this company is going to go bankrupt, but they are cash wise in reality. So they have credit facilities that give them the opportunity to just borrow cash at a 5% rate whenever they need it. So they only borrow it when they need it, and they don't have the opportunity cost of holding cash. So something else that is very important is the underspending on capex. So capital expenditure is not consistent with volumes. Normally in an oil and gas company, you would expect the company, if they want to continue growing, to, let's say, of the operational cash flow, they should spend at least half on capital expenditures to keep growing, because they need to drill, they need to search, like the exploring and so on, and it costs money. So you want to be, as a company, or as an oil and gas company, you also want to be investing in your growth. So it looks like they're not investing in growth, but as I told you in the first video as well, they are growing through acquisitions. And it's also something you could see on the first sheet that I showed you. Like they acquire, they optimize, and then they produce. And the final part from this is a typical UK exploring and production model as a perception, but that is not the case. They are only producing. Very important distinction. I can't emphasize that enough. So on to the final sheet that I would like to show you in the business model. Here you see the difference between DGO compared to traditional oil and gas companies and compared to mineral companies. So if you look at the stuff that they have compared, you see that they are obviously all in the green. So take that with a grain of salt, please, because obviously there's negative stuff that they could have put here as well. So they would have a yellow ball, like debt, for example, because they do have debt, and they don't do that. So they're focused on all the stuff that they have green. But still, it is quite impressive, especially when you compare it to their competitors, basically. So I'm going to start basically at the bottom, the dividend yield. Well, more than 10%. Right now it's about 16, 17%, I believe. But here you see as well, traditional oil and gas companies have a very good dividend yield as well. And you know that if you look at Royal Dutch Shell right now, it's like below 12 euros. So their dividend yield is very attractive. And same goes for Exxon Mobile, Chevron, and so on. Something else that I find very important in this, which we'll come to at the financial model as well, is the low capex. It's very nice. You see that they're usually very high in the traditional oil and gas companies. And something else that's very interesting is the PDP decline. So because they buy this low cost, long life, and low decline production assets, their decline in their reserves is very low. And well, margins, which we'll come to in the financial model as well, is also pretty attractive. Like you don't see that often. So that's basically it for the business model. Stay tuned for the financial model. I will upload that one tomorrow. I think that one is very interesting. The statements I think we're going to go through very quickly, and the last one, like the thesis, is also going to be very interesting. So stay tuned.